Have you ever felt like the market is sending mixed signals? On one hand, you hear about a massive flight to safety, with trillions of dollars pouring into bonds and cash. But on the other, a powerful narrative around artificial intelligence is driving certain stocks to incredible new highs. This isn't just you. Over the last 2 years, we've witnessed a profound divergence in how different investors are behaving. Professional institutions are playing defense, while many retail investors are still on offense. Understanding this split is one of the most critical leading signals for what could happen next in the markets. Today, we're going to break down this great divide. We'll explore where the money is really flowing, why it's happening, and what it tells us about the future of sector rotation. Disclaimer: this video is created purely for educational purposes only. It is not financial advice and should not be considered as a recommendation to buy, sell, or hold any investment. Please conduct your own research or consult a licensed financial advisor before making investment decisions. First, let's follow the money. The biggest story has been a historic migration of capital away from equities and into fixed income. By the end of 2024, global inflows for mutual funds and ETFs hit a record $1.4 trillion. And the primary beneficiary of this? Fixed income strategies, which captured over $1 trillion of that. At the same time, money market funds, which are essentially cash equivalents, saw their assets swell to an all-time high of $8.9 trillion. This was fueled by nearly $1 trillion in new flows in 2024 alone. Why is this happening? It's a direct response to one of the most aggressive interest rate hiking cycles in modern history. When central banks raise rates to fight inflation, the yield on safer assets like bonds and money markets becomes much more attractive. Investors, especially large institutions, saw an opportunity to get paid a solid return while taking on less risk. This is a classic defensive move. But here's the twist. While all this defensive positioning was happening, a powerful counter-narrative was taking hold centered on artificial intelligence. Following the release of ChatGPT-4 in March 2023, investor money began accelerating in technology, consumer discretionary, and communications funds. This created a strange, dual attraction market, where investors were simultaneously preparing for a downturn while also betting big on a technological revolution. This reveals a market with no clear, single direction. This brings us to the most important theme: the behavioral chasm between institutional and retail investors. Institutional investors are the big players: pension funds, endowments, and large asset managers. They manage enormous pools of capital, operate with long-term strategic goals, and have access to sophisticated research. They account for the vast majority of daily trading volume, giving them a huge influence on the market. Retail investors, on the other hand, are individuals investing for personal goals. While more empowered than ever, they can be more susceptible to emotional decision-making and short-term market swings. The data on their sentiment is fascinating. During a significant market sell-off in early 2025, institutional investor sentiment plunged to levels not seen since the start of the pandemic. They were clearly worried. But retail investor sentiment, it remained consistently bullish. In fact, March and April of 2025 were the strongest months on record for retail buying. This split is crucial. Some research suggests that high bullish sentiment among retail investors is often negatively correlated with future stock returns, while institutional bullishness is positively correlated. This could imply that retail investors are sometimes prone to chasing performance, providing liquidity for institutional investors to sell near a peak. It's a dynamic that highlights a core principle of behavioral finance. So, how does this all connect to a practical strategy? It sets the stage for what's known as sector rotation. Sector rotation is the movement of money between different sectors of the economy based on the business cycle. Let's look at 2 clear examples from today's market. First, the financial sector: banks, insurers, and brokerage firms. These are classic cyclical businesses. Their profits expand when interest rates rise because the spread between what they earn on loans and what they pay in interest gets wider. This makes them a prime destination for capital when investors anticipate an economic expansion. Now, contrast that with consumer staples. This sector includes companies that sell essential goods, like food, drinks, and household products. Demand for these items stays stable even during a recession, making them a defensive safe haven. But recently, this sector has been left behind. In one recent 4-week period, the consumer staples ETF declined over 8% while the broader market was up. Why? Because investors have been favoring high-growth, AI-related themes over safety. This creates a potential pendulum effect. If a market correction occurs, capital could quickly flow out of the overbought tech and communication sectors and into these oversold defensive havens as investors shift from seeking growth to preserving capital. This isn't a US story. Globally, the US market remains the dominant capital magnet. In Europe, we're seeing cautious re-engagement, with investors moving back into large-cap equities for the first time in 6 years in 2024. The UK, however, is a notable outlier, experiencing persistent outflows as domestic investors seem to be losing confidence in their local market. For fixed income investors, attractive opportunities have emerged. Interest rate differences between the US and Europe have made European credit a compelling alternative for yield-seeking investors who can hedge the currency risk. And finally, emerging markets have seen strong positive momentum in both debt and equity funds, helped by a weakening US dollar. So what should we watch for next? 2 major events will shape the coming months: Federal Reserve policy and the US election. The Fed has already signaled a pivot, with rate cuts projected for the future as it shifts focus from inflation to the labor market. This generally supports a risk-on environment, and analysts expect capital to move out of high cash allocations and back into bonds and equities. Historically, large-cap US stocks have performed well in the year following initial rate cuts. The US presidential election, meanwhile, is expected to create lower-tone, short-term volatility. Investors often hold more cash in the months leading up to a vote due to uncertainty. After the election, there's typically a relief rally as confidence returns. This brings us back to the central question: are the recent negative flows from equity funds just a blip, or are they a warning? With technology sectors appearing overbought and defensive sectors oversold, the stage is set for a significant market rotation. So let's bring it all together. 3 key themes define the current market landscape. 1. There is a clear and massive flight to safety, with record flows into fixed income and money markets driven by high interest rates. 2. This is happening alongside a powerful narrative-driven boom in AI and technology stocks that has defied traditional economic models. And 3. The most critical factor is the behavioral chasm between cautious institutional investors and bullish retail investors. This divergence is a key signal to watch for future volatility and a potential classic rotation back into defensive sectors. Navigating this complex environment requires looking beyond the headlines and understanding the deeper currents of where capital is truly moving. We hope this breakdown was helpful. If you found this analysis valuable, please hit the like button, share this video, and subscribe for more content that cuts through the noise. Let us know your thoughts in the comments below. Thanks for watching, and we'll see you in the next video.